Chapter 4. Interest and Dividend Income. The following forms and publications are used in the research and development of this lesson. Forms and publications are available at www.irs.gov. In this chapter, you will learn when to report interest income. Recognize which tax forms report income. Identify the difference between 1099 INT and 1099 DIV. Define when dividends are actually interest. Identify the different kinds of bonds. Identify the difference between ordinary and qualified dividends. Identify where to report dividend income. Know when a Schedule B is required to be filed with the tax return. Interest and dividends are interesting because it is very beneficial to you as a tax preparer to understand what it is and where they come from. But for the most part, it's fairly easy to process and report under the 1040 because you receive the form from your client and you enter the amount as shown in the form, and we will look at the form in more detail. It is a good step with your clients to review previous year tax returns to see where they have reported interest and or dividends. Many instances, the next year the client forgets or they did not receive it or it was lost and weren't aware. So your responsibility is to advise them. Oh, last year I see you had interest reported from Bank of America as an example. Did you receive one this year? So what is interest? Simply put, interest is money paid for the use of money. As you have a savings account, that money is in the bank and they utilize all those monies to make more money, and they pay you a percentage in interest for the use of your money. Some examples of interest, of course, are from banks, accounts at credit unions, other types of government entities, federal and state, or even bonds, CDs, certificates of deposit, life insurance, and installment sales. Now, when to report interest income? It is reported based on the accounting method. Now, we'll get into more detail what that means later, but either you have cash or accrual, and the taxpayer is using to report all income. If the taxpayer uses the cash method, then you generally report your interest income in the year in which they actually or constructively receive it. Now, it's important to understand what constructively means. There are times where especially self-employed individuals may have received income last part of the year but don't want to actually include it until the next year. So that's where the definition of constructively comes in. Constructively received income can be already on deposit or account, even if the taxpayer must make withdrawals in multiples of even amounts, give notice to withdraw before making the withdrawal, withdraw all or part of the account to withdraw the earnings, or pay a penalty on early withdrawals unless the interest received on an early withdrawal or redemption is substantially less than the interest payable at maturity. Simply put, constructively means I have received that monies. Whether I actually spend it or not, I am able to spend it. That's the key. Now here is an example of a 1099 INT. As with many other government standardized forms, the boxes all must be the same. However, you could receive such a form in a variety of sizes and shapes. Essentially, the payer's name, street address, city, state, zip code, and their federal ID number right below on the left. To the right of that, then, is the recipient's identification number, generally their social security number. Below that, then, the recipient's name, who has received the interest. So this is money you have received. You haven't done anything for it. Sometimes it's not considered as earned income, so you would not include it per se in some types of credits. Now, you have to look carefully at the credits to determine what will constitute earned income and versus what is not constituted earned income. So box 1 is primarily what we look at to determine how much interest you received. Normally we get these from Bank of America, Chase, Wells Fargo, and they show nominal amounts. I have $45 earned interest income received from my savings accounts or mutual fund accounts at Chase or Wells Fargo or wherever. So that's what you focus on is box 1. There is a possibility of something, rarely though, in box 2. If you have a special type of account such as a CD there and you pulled money out ahead of time, you may have some penalties in there, and look carefully at the chapter for adjustments to income, because that could apply there. Primarily, another box to focus on is box 4, federal income tax withheld. Rarely do you see any monies in this box for interest earned. Now, it's also important to keep it straight from interest paid. If you have a client who owns a house and has mortgage payments, they will receive a 1098, which is interest they have paid, and therefore can deduct that off of their taxable income, part of their itemized deductions. This is relating to the 1099 INT is for income for interest they have earned, and help your client to keep those straight is always a challenge. Now, it can be taxable interest is like savings accounts or CDs. Non-taxable interest is a Roth IRA or muni bonds. And again, under the 1099 INT, there is a box for tax-exempt interest that goes under line 8B. Now, there are sometimes dividends that are really interest. Certain distributions, often reported as dividends, are actually interest income. If the taxpayer received dividends from deposits or on share accounts from the following sources, they should report them as interest income: credit unions, cooperative banks, domestic building and loan associations, federal savings and loan associations, and mutual savings banks. Now, as far as what the client provides to you, it will still be reported. Even though technically it would be considered dividends, it is still reported to them and given to you under a 1099 INT, so you don't have to worry about keeping straight that is interest. Now, what is a dividend? Dividends are distributions of money, stock, or other property paid by a corporation. So I perchance own 1,000 shares of IBM stock, and there is a dividend paid against those stocks, and many instances your clients don't pull that money out, they leave it in there. Well, the assumption then on the part of the client is that that doesn't have to be reported as taxable income because you didn't spend it. And it's important for you to help your client understand, even if you didn't pull it out and spend it, you still earned it. You just chose to keep it in your account and it purchased another share of stock. So the taxpayer may receive dividends through a partnership, an estate, a trust, or an association that is taxed as a corporation. Again, some amounts received that are called dividends are actually interest income, but they will be reported on 1099 INTs. The most common types of distributions are ordinary dividends, capital gain distributions, and non-taxable distributions. An ordinary dividend are the most common type of dividend distributions. Ordinary dividends, including mutual fund dividends, are taxed as ordinary income. They are taxed at the same rate as wages and other ordinary income. Dividends received from common or preferred stock are considered ordinary dividends. Qualified dividends are the ordinary dividends received in tax years beginning after 2002 that are subject to the same 0% or 15% maximum tax rate that applies to net capital gain. They should be shown in Box 1B of Form 1099 DIV. Qualified dividends are subject to the 15% rate if the regular tax rate that would apply is 25% or higher. Most of your clients won't be in the upper tax brackets to be concerned with this. If the regular rate that would apply is lower than 25%, qualified dividends are subject to the 0% rate. That is why they are reported under line 9B, which is outside of the calculations toward total income. Here is a sample 1099 DIV. We look for primarily Box 1A, total ordinary dividends. 99% of the time, you will see the same amount that is in Box 1A also in Box 1B. And that is simply saying, if I have $50 of ordinary dividends in Box 1A, that those are qualified dividends as well, but you don't add those in tax. You would only include that, and you would pay an additional 15% if your regular rate was greater than 25%, meaning you were making a lot of money during the year. Another box to look for is 2A, total capital gain distribution. And that's usually, again, a smaller amount that shows in there, $35, $40, and you would include that, and we will look at that in more detail in the later chapters, but you would include that under capital gains, line 14. One other to keep in mind, again, you see it rarely, but it's possible that there was federal income tax withheld, and that is showing up under Box 4. The tricky part with these is after multiple years of doing taxes, and maybe once every 2 or 3 years, you would see something in Box 4, it becomes easy to not look at it. So get into a good habit of every time you see a 1099 DIV or 1099 INT to scan quickly. Actually, any form you receive from your clients, be sure to check out Box 4 for any federal income tax withheld. By the way, a rounding lesson to know when doing taxes. The IRS is not interested in your pennies. They are interested in your dollars. So use your rounding. If, for example, your total is $563.51, or that's what's showing under a 1099 INT or DIV or in any form, round up to $564. If you're the example there again, $563.49, round down. So that would make it $563. The IRS will never come after somebody over a rounding issue where their either tax payable or refund is a difference of $1. The other point that this doesn't make on this sheet is if it is $563.50, what do? 50 cents and up, you round up. Less than 50 cents, you round down. That concludes this chapter on interest and dividends. Be sure to go online to complete the review questions and the TPAs for Chapter 4. You must pass with a 70% or better to continue, and read Chapter 5 before the next lesson. Thank you.